In this video, traders, we are going to look at high success rate trading strategies. Stay tuned. Hey guys, a very warm welcome to you. Thank you for joining me. All right, so high success rate trading strategies come with this big warning. In other words, hey, you know what? They're high success rate, they work very, very well. You're going to get lots and lots of trades at work, but the one trade or couple of trades that don't end up losing big and end up undoing all of the good work. So these are really, really dangerous unless managed carefully. Now, I'm not saying that these aren't strategies you can employ. Of course, any strategy you can employ. You can go the other end of the scale and have kind of the black swan fund, which basically loses money, just buys massive out of the money, put options on stuff, and when it comes in big, but it loses constantly. So, you know, as a trader, we're trying to find a happy medium. You know, you really want to have something that's got a decent probability of success and a good risk-reward ratio as well. But let's look at these real extreme ones and maybe think about how we can perhaps manage them. So the first one is by selling options. Now, specifically if you're selling call options. So selling call options, fine. You're making money from the decay. You're making money from the fact that the market does nothing. You're making money from selling these out of the money call options, and even if the market chugs up, it doesn't quite get there, you're still going to make money. And you're going to make money a lot of times doing that. The further out the money you go, you're going to get less money for selling it, but of course the likelihood of it being in loss is diminished as well. However, the one time that market just rips is the time that you get your face cleanly ripped out of its socket, or arm ripped out of its socket, face ripped clean off, however you want to put it. You get the idea. The point is then it just ends up undoing all the profit. You've got the volatility is picked up as well. It's ripping to the upside. You're down on the option. It's just horrible. So yes, there are traders out there who are successfully selling these, and maybe they're using spreads to kind of manage it as well. But it's the kind of thing that, yes, it's got a high hit rate, especially with the further out the money you go, selling those. You're going to make money until the time that you don't. So the question really, as with all these, is how do you mitigate that? Do you kind of have some sort of thing in place that cuts it early, but then you end up undoing the ones that get almost away and then come back again? How do you do it? So that's something to think about. Next one is using Martingale with mean reversion. So what does this mean? So it means that if you are trading a mean reversion, i.e. you're looking for market to be extended to come back or extended to the downside to come back, basically not following the trend. And Martingale means that you can't really time the entry, and Martingale means adding, doubling up. Now I say Martingale here, Martingale is like adding 1 and 2, then 4 and 8, etc. Also just adding generally to the position. So what this means, especially if you're using Martingale, means that, okay, you add 1, then you double up the position, then you double up the position. It gets big pretty quickly, and most people think they can get away with it by starting small. And of course, you know, the market will very often, even if it pulls a long way, will rotate back, and the fact that you've doubled up your position means you need a small rotation back to make a bit of money. But you can see the downside of this, of course, is that as the market really stretches, your size gets massive, and all it needs is one final kind of flush, and you're in, and you're going to get capitulated out. So very dangerous strategy to employ. How could you use it? Well, I would never recommend this kind of thing, but let's just think if you were going to do it, you would probably have, you know, big spacing in between your ads. Maybe you wouldn't Martingale, maybe you just add to the position 1 and then another one, then another one, then another one, rather than doubling up, because that's really kind of puts you into a bad position. But then again, you know, for super high success rate, if you had that, you know, staggered out in the correct kind of format, you should never get to, or very rarely get to, that extra last double up, and it's always going to rock back enough for you to get out of the position. But we'd never recommend that. You know, that's just literally recipe for disaster, and that's really going to wipe you out. So just, you know, we're just kind of putting these for information purposes, guys, as well. All right, and also be careful, because some people who are doing the copy trading type things do this kind of stuff, especially when it's demo money. They don't care. You know, start off with £1 a point and go up to £1,000 a point, but you know who's going to do that in real life? Nobody. Right, number 3, scalping breakouts or opens for a few ticks. This is really high probability, guys, but when it doesn't work, it doesn't work. So in other words, you're literally on your breakout. If you can front run the breakout, and literally get a good fill and literally buy the breakout at one point and have a sell limit a couple of ticks higher. So you put a buy limit, it's not a buy stop that gets you in at a rubbish price. You get a buy limit over that breakout level, goes in, gets filled, momentum carries it up a few ticks. You're probably going to get a few ticks a lot of the time. Same with the open. If you're at the open, you see some momentum, you literally just jump on it with a 2-tick target, 3-tick target. You're going to get that most of the time. The chance of you just getting the top of that move is slim, but there's always that chance that when you don't and it rocks back, you're going to get hammered, and it rocks back quickly as well. So you could say, well, what if I put a stop in there? And yes, maybe, but then again, you're going to diminish the probability of this. The point is, if you've got anything where you've got a low target and you've got a wide stop or no stop, you're often going to rock back and come back and then finally take you out. So yes, as an example here, if you're sort of scalping the breakouts or the opening drive for a few ticks, if you can spot momentum and you can jump on momentum, the chance of you getting a few ticks extra are pretty high, right? They're pretty high. But also the probability that you just end up buying the top because you just get it wrong and it goes back against you massively without getting time to get a stop in. Or even if you put a stop in, you know, the noise just pings you out, so you end up having kind of 50-50 trade then. Is the way it works, guys. So, you know, just be careful. And also, if we extrapolate that onto any trade where you've got a small target and a wide stop, you know, I knew someone who used to trade with I think it was like a 12-tick target and a 150-tick stop. Well, yes, he said, oh, I've got a great success rate. Well, of course you have, because it can go back against you 50 ticks, 60 ticks, 100 ticks later in the day and then come back and get your 15-tick target. It doesn't make any sense. You know, the point is when you get stopped out, you've undone 10 profits. You know, how does that work? So anyway, is what it is. So watch out for that one. Number 4, fading a 1 ATR intraday. So these are a little bit more sensible, to be fair, guys. And if you can find a way to manage the risk, then good. But you know, fading a 1 ATR intraday is pretty high probability in the right environment. You've got high success rate. If you're constantly just fading that move, expected move, the chance of you getting something and having a low, again, if we kind of combined it and said have a low target, then the chances of you getting something are going to be pretty good. But then again, every so often, once a month, you get a trend day if you haven't got any risk management in place. But if you start to put risk management in place, then these don't become high success rate strategies. That's the whole point. You know, success rate, you can get high success rate because you don't have a wide stop or because you don't have a stop in. So watching that, if you had a 1 ATR being the average true range, 14-day, you know, expected range of the day, it says 100 ticks. You're fading 100 ticks, you're looking for maybe 10 ticks target. Most of the time, even if it goes 140 ticks, it's going to come back and ping you and take your limit. But the time that it goes 300, 400, you're going to be stuck short. So watch out for that. Pair trading highly correlated markets. Again, you know, these are strategies that can be the seed of something decent. But as we say, if we're removing the risk management aspect of it, they're super high probability. But as soon as you start to add risk management in them, they kind of diminish in probability. So it's finding that sweet spot. So this one could be, you know, your pair trading 2 correlated markets, whether that's gold and silver, not so much anymore. Maybe a stock like BP Shell. You get the idea, correlated. But the trouble is, I mean, and what you're doing is you're looking when one's going out of sync with the other, you're buying one, selling the other, and they come back into play. And especially if you add something like a Martingale or an adding strategy, as they go out and add, you add, and they come back and come back. Now, listen, the probability of success with that is high because unless they uncouple, which is rare, they are going to come back at some point. There's going to be that mean reversion, especially if you're trading bigger, less kind of volatile stuff, like, for example, BP Shell. However, the time when one just uncouples for whatever reason, maybe there's an incident, some sort of disaster on one of the stocks, or a CEO dies or resigns, or something that really creates a massive difference between the two, some sort of event risk, then of course they uncouple massively and you're down big. All right, guys, so those are kind of 5 high success rate strategies. We noticed here, like this one specifically, you know, this is a high success rate if you've got no stop loss in place. And you find that as well when you're kind of looking at systems and strategies. When you're not using stop, then they're very high success rate. But the time, how much drawdown you're prepared to sit through. If you're buying a breakout looking for a few ticks, are you going to sit through a 40-tick drawdown for it to come back and finally get you 2 ticks? You're not, because it doesn't work out. So with all these things, if you can think about stuff and ways of managing risk that still keeps the essence of the strategy, but without kind of giving you that open-ended risk that's just not really conducive to profitable trading, then there's something there. So have a think about those, guys. If you've got any more that you think should be included, I'll put them in the comment section below. I'll see you next one. Take care. Bye bye.